We've got a historic end to the week. On Monday, we were up for 5 consecutive days on the S&P 500. Today, we closed at 9 days up. That's the longest run for 21 years. If you follow Gann analysis, you'll know about the 7-bar rule, where any one move in one swing direction for over 7 days really increases the chance of a sharper correction. I'm watching you, MicroStrategy. That said, we're now above the 50% level for the corrective move on the S&P, which is a great sign and opens up the potential for new all-time highs. Earnings this week were surprisingly positive, with Microsoft and Meta being standouts, but forward guidance by Apple and Amazon on Thursday did give the market a bit of pause. For me, the most important day of the week was Wednesday, where we saw a notable change in character for the market, with risk on coming back in despite terrible GDP and non-farm employment data. The market dropped down at the open, but rebounded quickly at 10 a.m., which is a classic turnaround time, closing the day at fresh highs for the bounce. Aside from that, bond yields started ticking up again towards the end of the week, gold is cooling, and Bitcoin is marching steadily to $100,000. So what constitutes a risk-on versus a defensive market? And are we going to get new highs from here? Or will we first get a chance for another entry? We're going to dissect all that today as we look at the key charts for swing trading stocks, commodities, and crypto. Let's go. This isn't financial advice. Past results are not indicative of future performance. Do your own research. Welcome back to the Trading Apologist. My name is Tom, and I hope you all had a great week. It's really nice to see another green weekly close after that flogging we took in early April. The monthly candle actually looks pretty darn positive on the S&P 500. Now, before we dive into everything, if you do find value in the content, please like, comment, subscribe. It really means a lot to me, and it helps the content get out there to more people. Today marks the official start of month 2 for this channel, and we have almost 500 subscribers, so woo, little party. Anyway, let's move on. First, we have to start with a brief mention of bond yields. They started ticking up again on Thursday and Friday because the world is dumping US treasuries at a record clip. And countries that hold excessive treasuries, like Japan, are using their US treasury holdings as leverage in negotiations. As I said in previous videos, watch this sector. When we hit 4.5% on the 10-year or 5% on the 30-year, we'll most likely see easing on trade policy to juice the markets again. The bond market has a big problem, and it's in the driver's seat. Now, before we dive into the charts today, I just want to give you a little simple way to indicate if we're in a risk-on, defensive, or cash is king style market. I have to really thank Michael Pizzino of TIAcrypto.com for the inspiration on this simple breakdown. If you don't follow him and his brother Jason, give them a follow. They're fantastic technical analysts. They teach Gann swing analysis, they do time analysis, and they have a lot of great educational resources. Generally speaking, the market goes up 80% of the time, which is why it's so hard to make it as a bear. The trend is only moving with you 20% of the time. And that 20% of the time is the rare instance where the old saying cash is king could be true. If you look back at the past 25 years of trends in history on the SPX, the statistic works out pretty cleanly, with 5 of the last 25 years being true corrective years where cash would have been king. Beyond that, the broader stance is either one of risk on, where people are more in stocks, or a defensive style market where people are in gold. And here's how you can quickly analyze the broader market trend to identify which environment we're in. If gold is weak and the dollar is weak, then people move to stocks. This is a risk on environment. If stocks are weak and the dollar is weak, people move to gold. That's the defensive environment. But if gold is weak and stocks are weak, then people move to cash, i.e. cash is king. So what did we see before this corrective bounce? We saw more of a defensive market where people were clearly pulling out of stocks and moving into gold. And now I think is the time for more of a risk-on environment where the dollar is weak and people are moving into stocks, indicating risk-on is coming back in. We first saw this risk-on attitude come back in on the 90-day tariff pause pump. And as I said in the intro, what really confirmed it for me was this Wednesday, where we had such terrible GDP and non-farm employment data, but the market rallied regardless. So with that said, let's get into the charts, and I'm excited to bring back my favorite segment, Dumb Chart of the Week.
Dumb Chart of the Week.
Webull. I feel like I shouldn't even have to say anything about this and could just show you the picture of the chart, but let's spend just a second on it. This is why I always say don't chase pumps, especially after an IPO. This is a classic case of retail hype buying, in this case fueled by Wall Street bets, with big funds coming in after to dump their bags on them. If you take one thing away from my videos, it's please, please, please do not chase pumps like this and become the exit liquidity. And yes, the irony of a stock for a trading platform that's supposed to give traders an edge in markets, dumping on them like a meme coin, is not lost on me. If you happen to buy the top, your position is now down roughly 83.5%. which makes this the dumb chart of the week.
Dumb chart of the week.
Oh god, these charts really make me sad for the people that got wiped out, but with that said, let's dive into the not so dumb charts. So I'll bring up TradingView here, and we're gonna start on the S&P 500. Make this full screen and we'll look at the good. So we have our 50% of the move right here, measuring the top to the bottom, and we are cleanly above that. We closed the week above it, which is a fantastic sign for higher highs to come. Now that said, we are moving into the 200-day moving average and the 50-week right here. So we are right into resistance. And what I've been saying is this zone right here is where we're most likely going to see selling come in. And that's not just because of these resistance lines. That's also considering older investors who maybe experienced this drop and then didn't sell on this rally and then had to live through all this pain. If you don't have a lot of time for your portfolio to rebound and you don't want to hold through a volatile market like this, you might be seeing this pump and saying, hey, we're back to these levels. We're almost at 5,800 and it's time for me to take some off the top and de-risk because I don't have that much time left. That being the case, I see two potential paths for the near term. The first would be a bit of chop in this range and potentially breaking out eventually if buying pressure can overcome the selling to get to new all-time highs. And the other would be a bit similar with a bit of chop here, but if we can't break through, I suspect we go to one more low before we break out to test all-time highs. If we go over to the NASDAQ quickly, this is a very similar chart, and let me make this full screen as well. But you can see the NASDAQ is a bit stronger. We had this gap up here, and we are also just past the 50-week, and we are into the 200-day. We bounced away from it right there. So a little stronger percentage-wise, but we are at that exact same point of resistance and potential selling coming in. If we do reject from these, the lowest I would see each of them going, they both have a gap down here, which I have marked by this dotted line. So if we did not make it through and we corrected, I would see this as the logical bounce point, which is at 18,441 on the NASDAQ. And if we go back to the S&P, just to give you that number, that would be right here at just over 5,300 on the S&P. If we do go over briefly to the Hang Seng, this now almost closed its gap and it is showing relative strength percentage-wise compared to the S&P with this strong bounce. And I just have to pull this up. It's going to make me sad, but it's the trade that got away. If you remember from a few weeks ago, it just closed the gap here today. I got into BABA at around $98 and I said, this is such an easy trade back up to this gap fill at 125. It would have been an easy 28% to right there. But with the Trump administration saying that they might delist Chinese stocks, I got out at like 106. So I guess you can't win them all. And I made my choice to not chase that because of the potential risk. Because I thought, you know what, everything they're saying has been happening and they might just be crazy enough to do that too. And I missed out on this trade. But if any of you took that, congratulations. That was an easy 27, 28% in a couple of weeks. If we go over to the dollar briefly, it has been weak here and we've just seen a very meager bounce after these big pullbacks. I would have imagined more of a retracement, but we might start seeing that. On the daily, it's a little hard to see, but we've got a little bit of an inverse head and shoulders here on the dollar. So if we draw that neckline, I'm just going off very rough measurements. Let's go to the neckline there. That would take... Oh, sorry, trading alert. Anyway, really rough measurement on this inverse head and shoulders would take us to 102.50, which is right into this resistance zone that we have marked here. So actually, that's exactly what I was saying on this bounce initially, that I would expect a bounce into this zone and then an eventual correction lower with a continuation of the weak dollar. Okay, moving over to gold. And people were telling me that this wasn't going to stop, that it was going to go to 4,000. And you know what? It could have gone to 4,000. But what have we been saying about this? Parabolic blow-off top moves like this just aren't sustainable. And if you followed the videos from a few weeks ago, we were actually targeting 3,600, so it didn't quite make it there. But we said the most probable move is a blow-off top and then a bunch of chop and consolidation until gold figures out what it wants to do and potentially move higher. I'm not saying this is over for gold or it's going to drop way down like this. So if we just go back in time for a couple of examples here, I think around 2006 and then 2011 here was another one where a lot of consolidation. So this one, consolidation and then moved down. So that was, let's see, top to, we'll consider this right here, the breakdown, 75 weeks right there. And if we look at the 2006 one right here, I'll just make that a little bigger. This is a one where it continued higher, but this one right here was to the breakout, 65 weeks. So looking back to those past examples, perhaps 1.5 to 2 years of consolidation before gold continues to break out, which would put us, late 2026, early 2027, somewhere in there. But we'll have to see how this plays out. If we go in on the daily really quickly for gold, we did bounce and find support at this 3,200 consolidation zone. So I wouldn't be surprised to see the chop starting from here, or potentially we pull back to that psychological $3,000 level, and that's our range for the chop and finding our equilibrium before I imagine gold eventually carries on higher in the long run. Okay, one more commodity really quickly, just because I talked about this trade a few weeks ago and I just entered it. So this is natural gas, and we had this big head and shoulders with the blow off top, and then we broke below the neckline, and our target here is at 260. And I was expecting a bounce and a retest sooner to get an entry here, but we finally bounced, we had a retest, and I entered a fairly big position here, expecting more downside, especially with the summer seasonality and lower demand. And this is an example of a high reward going all the way down here to low risk trade, where I was able to put my stop loss here at this dotted line. So I'm only risking a couple percent, and I have all this potential upside on the short. And what I'm using to short is the KOLD ETF. I misspoke when I mentioned that a couple of weeks ago. I said COLD by mistake. So it's actually KOLD for the natural gas short, and BOIL, BOIL, for the 3x leverage long fund. And those can really help you amplify these moves on natural gas if you are inclined to trade that. Okay, getting into the fun stuff, we'll switch over to Bitcoin here, and I am on the daily time frame. So we are looking really strong from this bounce away. This horizontal yellow line, I can actually remove that. I put that in as May 4th. And that was just a bit of time analysis from this breakdown, judging how things can sometimes move in 30, 60, 90, 120-day cycles. And also looking at a quarter of this last correction, I thought, either half this correction time or a quarter would be probable. And we came in about that quarter time frame. This broke out a little bit sooner, but anyway, it's nice to sometimes just set relative targets on the chart so you can know what to expect. We did break above both this resistance line and this resistance line this week, which is very encouraging. If I go to the weekly just to show you the top one, which I think is the most important. So this lower one is an underside support from the bull market that we've dipped under twice. So that's just from this bull market. And this other one is going from the tops of the 2021 bull market. And we broke above that for a bit. Then we dropped back below. And now I'm hoping we sustain above this. And this line here is still relevant because this would be our general trajectory to continue to follow. And if we are strong, we are staying above this line. And if we start to break below it, that would be an indicator that momentum is coming out of the move. So just zooming in for some shorter term price action, I will turn on the VRVP, and we can also delete this downtrending resistance because we've now cleanly broken above it, and I doubt we would come to retest this line at a lower point because that would really invalidate the bull market narrative if we came back to that. So we can delete that, clean up the chart a little bit. And looking at the short term, we are into this big volume cluster here. We're just to the top of it. And this zone right here, right below 100K, you can see we have all these historical tops right here. So we are right into resistance, and you saw we rejected from that today. We might be able to push through and go to that psychological 100K number, but I do anticipate some kind of resistance coming in here. And I would very much like to see actually a bit of a correction. Maybe we back test this line and then bounce away just to build some structure. Because if we move up too quickly in a straight line, it's not going to be a sustainable trend. And then we'll come crashing down much more quickly than I think anybody here likes. So if we're looking at that, that's at about 92.9. I could see us going actually all the way down here to this like 91.5 level. Anywhere in that zone, 92 to 91.5 would be a strong bounce and retest. We could go as low as this 88.5 right here, but that would be the lowest I would want to see it go. So we're not breaking these old tops. But again, if we bounce from that 91.5 or anywhere up here, that would be the strongest sign for me that we're just continuing this as a bit of a bull flag, and then we rocket away to the next price target. So where are we thinking the price could go? And there are lots of projections out there around 120, 150K. And this is a bit speculative, but I'm just going to bring up the M2 again. Sorry about the technical difficulties. We're back now, and I have this mapped to the 90-day offset. And again, this is nothing super precise, but I'm just roughly mirroring it to this chart and thinking about where and in what time frame we could find support and resistance. So we are a little bit ahead of schedule here, but you could see right around 100K here would be a bit of resistance and consolidation. So maybe this corresponds with some of the correction we're seeing now before another move up, and this would be in early June to that 113 price range. So that would have us into new all-time highs. And then as far out as liquidity goes right now, potentially by late July or early August, we could hit 131K. Again, totally speculative. We can't see into the future. This is just an offset of how much global M2 has been increasing, and historically seeing that a percentage of that flows into stocks and Bitcoin. So this will be interesting to follow. And if the trends continue to be correlated, we'll keep bringing it up. And again, remember, Bitcoin only correlates to global M2 80% of the time. You can see periods like right here where we had divergence from the trend, but other points right here, it works in concert with the trend. And then here for this peak in the middle, we had a bit of divergence. So it's not exactly perfect, but it does give us a bit of a roadmap for the side of the chart that we can't see. Okay, let's move on to Solana, my messy Solana chart. My apologies. But as you can see, compared to the Bitcoin trend, I'm just on the 4-hour chart. I can go over to the daily here. We're also consolidating a bit. The last couple of days, Bitcoin has continued to move up and Solana has consolidated. I'll turn off the volume for now and I'll make this full screen. The one thing I am looking at here, because we've been having a hard time getting above this $150 range, is this yellow diagonal line, which let me zoom way out. If we look at this for the last year plus, so starting in, this range here around January of 24, this has provided support for the bull market. And then actually we got a bounce here. And then once we got underneath that, it turned into resistance and we were rejected here. We peeked our head through it. But if we go in close, you can just see, it's so funny how this trend line from well over a year ago can give us exact rejection points here from the underside. So this is our big hurdle. We need to get above this and flip it for support. And beyond that, that $180 is still my target off the big inverse head and shoulders off the bottom. But we really need to just break through this. I anticipate the broader markets correcting a little bit next week. So maybe we see a bit of that in crypto too, and we correct down to say the 130 range before heading back up. But all that to say, right now, I think on the bigger picture, Solana is still looking strong, but there might be some intermediate weakness here as we correct a little bit in broader markets. Okay, last thing, just being a bit of a degen, I am going to bring up Fartcoin just because this has been such a good trade for me, and I just got out on a take profit on one of my trades. So I got in on this retest because we had this cup and handle right here. I missed the breakout, but it came back down, so I loaded up a bigger than would be considered responsible position for a dumb meme coin like this. But the target was at $1.13 and it ran up, and I took some profits here, and then it still looked like it had more in it. So I reloaded and I set a take profit just below this line here that lines up with these other peaks, which is at $1.30. I set at $1.27, and that triggered yesterday and got me mostly out of the trade. And now just for fun, I have a little bit left to see if we can hit some of these higher targets. But as you can see by the trend, it does feel like it's losing a bit of steam. If you just look at this move up right here compared to this move up, and then this last one right here, how it was much more muted, you can see that we're just losing a bit of steam on these moves. Also on the daily here, our RSI is getting to the top of the range. If we break this trend down. And I love crypto just because it respects these RSI trends so cleanly. If we break this down right here on this retest, then that would be my sign to get out of the rest of my position. But if we bounce away, we can easily on the daily go into overbought territory. Then I might reload on this move and just see what it has left in it. But I suspect in the next couple of weeks, this is going to see its intermediate top and then we'll correct for a bit. But it's been a nice ride while it lasted. And I would just say, you know, if you're not marrying these things, if you are watching the charts, they do respect the levels and pattern targets and RSI so cleanly. So if you're trading and you're getting out in a few days' time and you're not holding on to it as a long-term investment, you can make some good returns on these kinds of coins. Okay, looking at a couple of proxies, we'll just look at MicroStrategy here on the daily. And a couple of weeks ago already, we were talking about this breakout here. So we're now at 8 daily bars up in this one swing direction. As I was saying in the intro, anything above 7, you can see 7, 7, 8 here, generally tends to see a bit of cooling off or a bit more of a correction. Sometimes it's a sharper correction, sometimes it's just longer and drawn out like this. Not that I don't want to see MicroStrategy explode, but it also needs to take its time and build some market structure. And on the daily here, we're already to the top of the range on the RSI. We have this potential underside support. I would love to see things cool off and retest this line before exploding back up. So I know it sounds funny to say that you don't just want a stock to go to the moon, but what I don't want for MicroStrategy is you can see this increasing clip for next week for us to just explode like this and then come crashing back down and then have another big long correction. I would much rather see us consolidate, build some market structure, and then figure out where we're going to go and hopefully make our way higher down the road. Granted, if we do just keep going up from here, the daily surely has a little bit of room left to run on the RSI and on mean reversion, but then I would adapt your plan and it would be time in my mind to exit some of those positions or hedge them with covered calls because that move isn't going to be sustainable. If we flip over to the 4-hour time frame just for a bit of contrast here, you can see that mean reversion on the 4-hour already in the midpoint of this move a week ago hit historical highs on the 4-hour and is now starting to cool off a little bit both on mean reversion on the RSI. We are, you could argue, starting to see a bit of bearish divergence with the RSI printing lower highs here, and we're printing higher highs in the price, but it's not too much of a divergence at this point. But there are just some signs that this is getting overheated, and again, for healthy market structure, I would love to see a bit more chop and consolidation before we continue to rocket on up with the price of Bitcoin. If we are going over to the Bitcoin miners real quick as proxies, you can see that CleanSpark right here did have a bit of strength. We're up 40% from the bottoms. And so while this might not look like a lot, this is a big move for these stocks moving from, $6.50 to $9.30. We are finding a bit of resistance here at these old bottoms. But if we can break through this, then I suspect $10.60 is our next stop, and that 200-day moving average will intersect right there. CleanSpark does have the best fundamentals in my mind, the lowest cost of production, but the chart is definitely weak. It hasn't rebounded as much as some of the other miners. So sometimes even though the fundamentals are there, the chart tells you what's going on in terms of investor sentiment and what stocks they're backing and which ones they aren't. If we go over to Mara, in contrast, Mara has definitely bounced away stronger. As we've been saying, we broke this downtrend right here. But we are coming into this most traded zone at just under $16 here, which you can see has historically been kind of a floor range for that stock. So I would say we're just starting to get into a zone that could provide more resistance here between about $14.50 to $17.50. Okay, moving over briefly to the semiconductors, I'll start with SMH, the VanEck Semiconductor ETF. And you can see we broke this downtrending resistance. We are still under the 50% level of this corrective move. You can see semiconductors topped way back here in July of 24. If you look at the NVDA chart in contrast, which we will in a second, you'll notice NVIDIA was lower in July and then it peaked right here towards the end of the year, where the broader semiconductor space formed lower highs during that period. But right now it's correcting fairly well, but we're still not past that 50% level. If we do look at NVIDIA in contrast, you can see that this little downtrend here was also broken on NVIDIA. We're also not back above the 50% of the correction, but this was that interesting divergence where the broader semiconductor space was stronger last June and July, and then weaker here where NVIDIA was stronger here. So all of these still have some work to do. But the interesting one for me is TSM, which we've been looking at as being a standout in the space and a bit stronger. And unlike the others that are under the 50% level, TSM right now is into the 50% of the range. We're coming up to the 200-day moving average. So it's definitely got some work to do. But generally speaking, compared to the rest of the space, it is looking much stronger. And like NVIDIA, it didn't have those high tops in June and July of last year. It peaked around the same time as NVIDIA and then had that same pullback, but now is rebounding with a bit more strength. So one to continue to keep your eye on, and one that I have a position in. Okay, if we go over to Tesla now, this is another one that really needs to make a decision. We broke this little bit of a downtrend here. We didn't correct much at all on earnings, and we've just been coiling right here under the 200-day moving average. We poked our head above it twice, and this is really at a point of decision. I would love to see it break through and reclaim some strength in the low $300 range, but we just need to see how things play out with the broader market. I suspect if there is going to be a correction in the indices next week, that we would see a pullback on Tesla, and we could anticipate obviously 250 as a big support zone. And then if we really came down, maybe we would retest this line here for a bit of support. But let's see what the broader market does, and keep your eye on this one, because when things are compressing and coiling like this beneath a resistance level, often they can have an explosive breakout. So we'll see if that happens next week. If we're looking at one that you're probably tired of me talking about, Hood, I'll make it full screen. We did have that breakout from the head and shoulders right here. And you can see that white line right here is my target at about that $62, $63. We also broke this downtrending resistance, and we had earnings this week and just a little bit of chop and indecision after earnings. Generally, I think the stock is looking strong. It's holding up better than the broader market. If we take the 50% right here, we have just been dancing around that, but we did close the week just above it. So I'm hoping we can reclaim that 50% as an area of support, and we can continue to bounce away to this target right here. If we look at a beat up one real quick, just because I haven't talked about it in a couple of weeks, Deckers continues to form this kind of ugly inverse head and shoulders, but an inverse head and shoulders nonetheless. And from the breakout point here, that would put the target in the high $30 range, which would make sense with this little consolidation zone. I've been building a position in this because I believe in the company and I run in their shoes, and I know a lot of people that work there. I don't know, I'm just kind of a fan. But I suspect something like this with all the tariff stuff going on, even though we have a rounding bottom, we have a bottoming pattern with a clear target, I don't think it will rebound to all-time highs as quickly. So I'm going to see where this goes. Hopefully we can hit that target. Maybe we intersect the 200-day moving average, but I would most likely scale out of some of this and move it into a faster horse, especially with crypto and different things running right now. And, you know, maybe something like this is a play that I could rotate into down the line after some of those fast names have run. If we're going to another beat up one, but one that has been recovering stronger, and we reviewed this on Monday's video in terms of relative strength while the rest of the market was crashing during tariff news, this was rallying up. And right now, I still have this 50% range drawn for that big earnings bump last quarter. And then we corrected down, I reloaded, and we've been building this bull flag. We have earnings next week on the 6th, and we're correcting just a little bit into that, but we've been finding support at these previous peaks. And you can see we have this huge volume cluster here now. So earnings next week on the 6th, I think will really determine the trajectory of this. But I actually stacked just a little bit more this week because we're into that support. And I suspect this move will continue on earnings, but time will tell. And I guess we'll review this next Friday to see how this one is doing. But it does have a lot of potential upside. Like I was saying, if we can break that $42 level for this trading zone right here, I could see us going all the way up to 61. If we're talking about all-time highs, we're just under $100 right here. A lot of room to run for this one to get back to all-time highs. And again, on these kinds of bounce plays, you don't necessarily need to do that if you don't think it's going to get back there, but they can sometimes be worth just playing a bit of that rebound and taking it from there. Just for giggles, let's draw the 50% so we can give ourselves a target of where we might anticipate bigger picture resistance. And wouldn't you know, that $60-ish that we talked about with those previous tops, that's also the 50% level. So it's always fun to see confluence when you're just looking at a chart and you see a trading zone right here where things bounced and found resistance that also happens to be the 50% of this bigger move. So that, I would say, to me, is a good target. If I can get this position to get up to that $60 range, I would be very happy with that exit, and then I would rotate those funds into something else. All right, saving the strongest for last. We're just going to end on Palantir. We were talking about this last week. We are here on the daily, and we are almost back into all-time highs. This is stronger than most any stock I've seen in comparison to the broader market pullback or that tariff announcement pullback here. So I would anticipate, just as we're testing those old highs here at 125, to see some resistance. And I don't have much of a forecast for this outside of anticipate some selling up here. And if we see a pullback and then break back through, that would obviously be a sign of strength for more upside. If we're just talking fundamentals on this, the PE ratio is crazy and I think a bit overheated. But these kind of hype names can definitely run, and sometimes they get out over their skis a bit, and eventually we see a sharper correction. Also, as we've been talking about, big explosive moves up not being sustainable, this would be that kind of pattern. If we're talking about a more sustainable uptrend, this kind of pattern right here, or even this one right here with a little steeper incline, are definitely more sustainable. But this kind of move right here that just shoots up is not sustainable. So I wouldn't be surprised at all to see a pretty sharp correction from this next week. If the broader market corrects, it would just move along with that. And the correction here would most likely be more severe than the rest of the market. Okay, so that's it for the weekly wrap up. I hope that was helpful to give you a sense of the broader state of the market, how risk on is coming back in, how we do have potential for correction, but that might give us some good entries. And generally, I would say things are looking good for the upside, despite things looking a bit shaky out there. Remember, the market isn't the economy. There is so much money printing going on, and we have so many regulatory tailwinds for a bunch of industries. So don't let the broader fear out there keep you from taking advantage of opportunities. I'll see you guys on Monday. Have a lovely weekend. Bye for now.